In today's video, we're going to break down an important aspect of investing, and that's the difference between passive investing and active management. Both approaches may sound good on the surface, but there are distinct differences between the two. Let's break down the difference between these two in a very simple way. So first we have passive investing. The idea behind this strategy is just simply owning the market rather than trying to beat it. Instead of picking stocks and timing moves, you invest in funds that track like an index. This would be like the S&P 500 or the total US stock market. The goal with passive investing isn't to outperform. The goal is consistency, diversification, and low cost. So now what is active investing? Well, it's the opposite approach. With active management or investing, you are trying to beat the market. That can mean picking individual stocks, hiring an active fund manager, or using actively managed mutual funds. The idea behind this is simple. If you make the right moves, you can outperform the index. And while outperforming the market sounds great, there is a large challenge that comes with it. It's really hard to beat the market consistently, especially after fees, taxes, and even timing mistakes. So let's talk a little bit about fund managers. In active investing, you are relying on that fund manager to make decisions for you. That includes what to buy, what to sell, and when to do it. Their job is to analyze markets, research, and attempt to outperform an index. In passive investing, there's no manager trying to beat a market. The fund simply tracks an index. There's no individual stock picking. Some asset classes may be better suited for passive management strategies. An example of this is large cap growth, which tends to be really efficient. Other asset classes may benefit from active management, such as small cap or international, where these skilled managers may be able to provide extra value. So here's the key difference between active and passive investing. With active funds, your results heavily depend on the people managing them. With passive funds, your results depend on the market. Great managers can add value, but it's really hard to do it consistently and even harder to outperform after fees are taken. So another distinct difference between active and passive funds is the difference between costs. Active funds usually have higher expense ratios, more trading, and therefore more taxes. Passive funds tend to be lower cost, more tax efficient, and more predictable. So now the question comes down to which one is better? And here's the truth, it really depends on the individual. The real risk in your investing isn't between active or passive investments. The real risk is not having a plan and reacting emotionally to markets. It's not all about beating the market this year or next year. It's about building a strategy that works for you over decades. If you like videos like this and would like to continue learning more, please consider liking and subscribing. Thank you for watching and take care.